So today we start new slides. So it's finished with the statement of cash flows. If you want later, I can give you the answers to the calculation of Nestlé cash flow statement. I put some ratios and I can give you the correction with the calculation of the ratios. But today we start with a slide of the session 3 and 4 because we have many things to see. So I prefer to start the new section. In the cash management 2021 session 1 and 2, normally you have the correction of what we did, the MCQ, and you have the charts used during the course, and I said I will put in the PowerPoint. So normally is complete. You have all you need for the revision in the slide of the session 1 and 2. And if you have some difficulties with the statement of cash flows, you can go to the chapter 6 and chapter 17. Maybe later I can give you the correction of the exercises in the chapter 17, and I can put the exercises of the chapter 16 with the correction. You can remember me this if I forgot. So now, cash management section 3 and 4, the PowerPoint. I forgot to put the reference here to the financial accounting and reporting book, but you have the chapter 16 and 17 of this book from Stollery, Ding, and Pingham. So today we will see, it's not exactly the session we did. We did the session 1 and 2 here. Here it's the session 3 today. And also, maybe we will start this one. Okay, and here's the section 5 and section 5. So today we will see a different presentation of the balance sheet, the simplified balance sheet. If we have time, we will see the managerial balance sheet also, and we will see the liquidity approach through the balance sheet. So first, before this, we can talk about the cash budget, which is a different presentation of the cash from the statement of cash flows. In the cash budget, you put the opening cash, you put the receipts, you expect receipts from operating activity. You can put also some receipts from investing activity. So in the first part, you have all the operating and investing activity. You have the receipts, you have the disbursement. Disbursements. And you have the expected minimum cash. So you can include in your cash needed what you need is because of the disbursement and because of the minimum cash you want at the end of the period. And you will compare the total cash needed with the cash available. What is available is because of the opening cash and the cash created during the period. If the cash available is higher than the cash needed, you have an excess of cash. If it's not the case, you have a deficiency of cash. In function of this, you will decide about your financing activity. Do you need to have more new debts than repayment of debt? Or you can have more repayment of debt than new debt? Do you need to issue shares, if we suppose the cash budget is for all the company? So the financing activity is in function of the rest of the activities, in function of the operating and investing activities. and you calculate what you need in function of the cash excess or deficiency. And at the end, you have the ending cash in function of your financing activity and in function of the cash excess and deficiency. So it's a different presentation. You put the receipts in one side, the disbursements on the other side, and you define the financing activity in function of the operating and investing activities. I just need to plug the laptop because I think I will have a problem. Okay. So you can define the cash budget for each quarter, each month, as you want. And you can explain the change in cash between the opening cash at the beginning of the year and the ending cash at the end of the year with all the expected receipts, all the expected disbursements. So here normally it's a forecast. So now we will see what is a simplified balance sheet and how we can use it in order to have some liquidity approach. So we take the example of Apple. In the US, like in Vietnam, we start with the current assets, and after we have the non-current assets. So we start with the most liquid, and we finish with the least liquid. Here, so it's for the assets. For the liabilities, it's the same. We start with the short term, and we finish with the long term. So this is a general presentation in the balance sheet in the US. We start with short term and we finish with the long term. Why do we do that? We do that because normally from the balance sheet, we want the working capital. And the working capital is the current assets minus current liabilities. We have also the current ratio. Current ratio, it's current assets divided by current liabilities. So if your working capital is higher than 0, it means that the current ratio is higher than 1. So we want the working capital thanks to the balance sheet. So we want first the current assets and we want the current liabilities. The idea of the working capital is to define your capacity to pay what you will have to pay during the next year. So here we have a cash outflow for the next year because of past transactions. Because of the past transaction, we have the balance sheet, we have the effect on the balance sheet, and in the current assets, current liabilities, we separate what we will transform into cash during the next year, or is already cash, and in the current liabilities, what you will have to pay during the next year. So the working capital is the difference between normally what you should collect during the next year and what you should pay during the next year. But only because of past transactions. So it's interesting, normally your working capital in a small, medium enterprise should be higher than 0 in order to have the capacity to pay what is already due with what you already own. We have other liquidity ratios. So we saw the current ratio, which is related to the working capital. And we can have other ratio. Here, the difference with the current ratio, it's we don't include the inventories. So minus the inventories. We don't want the inventories. So we suppose it's not so easy to sell the inventories and to collect the cash from the inventories. So it's better to have the cash or the account receivable than to have the inventories from the point of view of the liquidity. So from the current ratio of more than 1, we can finish with a quick ratio of less than 100%. In the cash ratio from the previous one, now we eliminate the receivables. So you can have also problems with the receivables if the customer are not able to pay. So with the cash ratio, you are sure you have already the cash, or you have financial assets you can transform easily into cash. So with this part, you are sure at the minimum you can pay this part. So here, if you have 20%, you are sure at the minimum you can pay 20% of what you will have to pay during the next year. In the balance sheet in Europe and in many countries in Asia, we start from the non-current assets. And after we have the current assets. So it's a French company in agribusiness, food processing industry, Danone. So we start with the least liquid and we finish with the most liquid. So it's the reverse of the US presentation. On the other side is the same. We start with the long-term maturity and we finish with the short-term maturity. And why do you have this presentation? We have this presentation in order to calculate also the working capital. But it's a different calculation of the working capital with the same result at the end because the balance sheet is balanced. But now what we want is the long-term financing minus the accumulated investments for the long term or the long-term needs. So the working capital here, it's a different perception. We want to know if we have enough long-term financing in order to finance the property, plant and equipment, intangible assets, and so on. So it's a perspective of the bank. When they finance some company for the long term, the bank wants to know if the working capital is positive and if the company is financing the investments with a debt with a good duration. So here is non-current liabilities, it means higher than 1 year. Non-current assets higher than 1 year. So normally, if you have an investment for a property plant equipment, you will depreciate during 10 years. You should finance this property plant equipment with a debt, maybe with a debt or repaid over 10 years. So normally you finance what you need for the long term with a long-term financing. And the equity is considered as long-term financing because you will not repay the shares to the shareholders. So in the French calculation, we use equity, non-current liabilities, and non-current assets. In the American calculation, we use current assets and current liabilities, but at the end is equal because non-current assets, so here we have equity plus non-current liabilities minus non-current assets. On the other side, we have current assets minus current liabilities. So in one side, if we put the current liabilities on the other side and the non-current assets on this side, we finish with equity plus non-current liabilities plus current liabilities is equal to the current assets plus non-current assets. So it means if you have an excess of financing in the long term, so the excess by comparison with what you need because of the investments in property, plant equipment, intangible assets, and so on. If you have an excess of financing on the long term, you can use it in order to finance the cash or the net cash. So you use the excess in order to have the net cash and in order to finance the operating working capital. So in the working capital, you have two parts. You have the net cash and the operating working capital. So normally you need an excess of long-term financing over the long-term needs. In order to finance the short-term needs, what do you need in the short term? You need operating working capital because of your operating activity. You need accounts receivable, you need inventories, and you need to finance only the net amount. It means minus the accounts payable, minus the tax liabilities, minus the social benefits liabilities, minus the earned revenue. So what you need to finance is the net amount between current operating assets and current operating liabilities. And what you need to finance also is the net cash. It means the cash and short-term financial assets minus the short-term debt. So we want something positive here in order to finance some positive operating working capital and to finance some positive net cash. So we can find the working capital from the short term. It's the difference between current assets and current liabilities. In the current assets, we have current operating assets and we have current financial assets. In the short term for the liabilities, we have current financial liabilities and we have current operating liabilities. So when we say the working capital is equal to the current assets minus current liabilities, we can say also it's the current operating assets minus current operating liabilities plus current financial assets minus current financial liabilities. This is the net cash. This is the operating working capital. So we can split the current assets and the current liabilities into two parts. One is what is directly related to your operating activities, accounts receivable, inventories, prepaid expenses, accounts payable, accrued expenses, deferred revenue. And the rest is more financial. It means you can receive interest, you can receive dividends, or you can have to pay interest because of this. In reality, in the cash and cash equivalent, in the US, they separate two kinds of cash, the excess of cash and the cash needed by operating activities. So in the US books, you can see a distinction, two kinds of cash, the excess and what you need because of the operating activity. And the cash needed by operating activity is related to this one. We put this one with the operating working capital. So sometimes the operating working capital is with the cash needed by operating activities. But it's very difficult to define this cash. So generally, it's a percentage of sales revenue or a percentage of operating expense. But how to define the cash really needed by operating activity? So it's difficult to say this is the cash we are sure we need if we are from outside the company and we want to analyze the company. If you are inside the company, you know the evolution of the cash every day, every month, so you can determine a limit, the cash needed, because at this moment of the year, we consume a lot of cash. We are not creating a lot of cash, so we have a deficit of cash. So we need this cash at the minimum because we have a huge negative net cash, net operating cash at this moment. So the cash needed by operating activity can be defined in the company, but it's difficult to estimate from outside the company. The other way to calculate the working capital is to take the long-term financing and the long-term needs, the accumulated investments in non-current assets. So the working capital is positive here, like the working capital is positive here. In the previous part, the working capital is positive if the current assets is higher than the current liabilities. Now it's the reverse. It's positive if the long-term financing is higher than the long-term assets, non-current assets. So we say we can split the working capital into two parts. So we suppose we put all the cash in one side. So here is more a European presentation. Is not the US presentation. So we don't put some cash needed by operating activity in the first part. We put all the cash in the second part. So the working capital, we say, is current assets minus current liabilities. And we can split the current assets and the current liabilities into operating and financial, or operating and non-operating. Okay, so we split each one into two parts. So now we can say the working capital, we have the operating working capital or working capital requirement. In this part, we take all the current assets minus all the financial assets. So generally, the way to calculate this one is by difference, because we have many things in the current operating assets, many line items. So generally, we prefer to take the total current assets, which is available in the balance sheet, and we exclude the cash and the marketable securities. We exclude two lines, and the rest is in the current operating assets. We do the same for the current operating liabilities. Generally, we take all the current liabilities minus the financial liabilities. The rest, it's in the current operating liabilities. So with the operating working capital or working capital requirement, you know what the company needs to finance in the short term. They need to finance what is not already financed by suppliers, accounts payable, by employees, social benefits liabilities, by customers, earned revenue or deferred revenue, by the state, tax liabilities. So one portion of the current operating assets is already financed by the current operating liabilities. What you need to finance is the net amount, the difference between the assets and the liabilities. So with the operating working capital, you know what you need to finance, and sometimes it's negative. If it's negative, you don't have to finance your current operating assets because it's already totally financed by the stakeholders, state, employees, suppliers, customers, and so on. So in the big companies, generally, the operating working capital is negative because it depends on the power you have in front of the customers and the suppliers. If you have a huge power, you can say to the customer, you have to pay cash now. I don't want accounts receivable. Or you have to order before I give you the good. So you order, I produce, and later I give you the good. So you reduce your inventories, your finished inventories. And you say to the suppliers, I will pay you in 2-3 months or more than that. So I create huge accounts payable. And you say to the suppliers, give me the raw materials, the components, only at the moment I need it. So you reduce your components inventories, your raw material inventories to the minimum. So because of this power, you can reduce the current operating assets and you can increase the current operating liabilities. For the operating working capital, the evolution of this one, what we want generally is this ratio, operating working capital divided by the sales revenue. So we are very interested by this ratio, operating working capital divided by the sales revenue. In the short term, we can suppose this ratio is fixed. So in this case, when you increase the sales revenue by 10%, you also increase your operating working capital by 10%. So this is a good relation. Because you increase your sales revenue, you should increase your operating working capital. This is a normal relation. What we don't want, the bad relation, is you try to increase your sales revenue by increasing the operating working capital. So because you increase the credit terms to the customers, because you increase your finished good inventory in order to have all the possible products the customer wants, you can increase the sales revenue. It's easier to say to the customer, you will receive the product today and you will pay in 3 months, than if you say you have to pay now, but you will have the product only in 1 month. So the problem is you can have a huge finished good inventory, too much finished good inventory, so you consume the cash, and a huge credit terms, so you don't have the cash from the customers for the moment. If you are using this relation on the left side, in this case, you increase the ratio. So with this ratio, you can check we are not using the credit terms to the customers and the finished good inventory in order to try to increase the sales revenue. Because normally, if you increase your sales revenue, it's because you have the good mix between selling price and sales volume in function of the price elasticity, and because you have good salesmen that they have the capacity to sell your product. And of course, you have a good product. But if you are using the credit terms of the finished inventory, it's because, in fact, you don't have a really good product, you don't know how to sell it, and you don't have the good mix between the selling price and the sales volume, the price elasticity. So with this ratio, we can check you are not trying to use the credit terms and the finished inventory. And in the long term, the normal situation in the long term, if you increase your market share, you should decrease the ratio. So a good performance in the long term is the capacity to reduce the ratio. So maybe we can create one Excel file, and I show you the liquidity problem we can have in some companies. So I suppose we have sales revenue, we have a variable cost in percentage of sales revenue, revenue equal to 60%. We have a cash fixed cost, so excluding non-cash fixed cost, D&A expenses equal to 5,000. Near the sales revenue, it's 12,000. We have an operating working capital in percentage of sales revenue equal to 30%. And now we will calculate the operating cash flow in function of the expected change in sales revenue. So sales volume effect, with only the sales volume effect. So if we increase by 10%, what we can expect? So for the calculation here is without income tax. So it's very easy. We use the sales revenue minus variable cost. So we have what we name the contribution margin minus cash fixed cost. We have the EBITDA minus the change minus increase in operating working capital. We have the operating cash flow before income tax. Okay, we don't care about the income tax in this example. So the sales revenue is so we expect to increase by 12%. So is 12,000 multiplied by 1 plus 10%. So here is the initial situation. And here we have the cash flow calculation, operating cash flow calculation after change in sales volume. Okay, so here we have the inputs. And here we have the financial model. Okay. For the variable cost, we continue with 60%. It's just the volume effect. So now the contribution margin is the sum of the two. The cash fixed cost is 5,000. So the EBITDA is 280. The increase in working capital is minus the 10% multiplied by 30% of the initial sales revenue. So we want just the increase. So the other calculation, if you want, is opening operating working capital, ending operating working capital, and now we have the change in operating working capital. So the opening is in function of it's a 30% multiplied by 12,000. The ending is 30% multiplied by the new sales revenue. So the change is this one minus this one, 360. And what we want is minus the increase, because when we increase, it's a cash outflow. And so now the operating cash flow is minus 80. So maybe we can put more. We start with 14,000 in order to have something positive. So 740, okay? And now we suppose we have the capacity to increase more the sales volume. We have good perspectives. So we will do the sensitivity analysis in function of the change in sales revenue in percentage, okay? So we take the situation of 5%, 10%, 15%, 20%, 25%, 30%, 35%, 40%. And what we change also, or we change only this one. Yes, we change only this one. So sensitivity analysis, but only with one input. I change only one input. So I put here this one, and I change only this one. Because we have the possibility to do with two inputs, we change at the same time. Here we do only one. Okay. So we want the effect of the change in sales revenue over the EBITDA, over the change in operating working capital, and over the operating cash flow. Okay, so I should put not a minus because I will have a number in minus. I want a plus, so I put plus here, equal. Here I put the increase, directly the increase. And here I will put minus in the calculation. So I use this one minus this one. Okay. So, and here I need a new line. So with the sensitivity analysis, I will study the situation. If I increase sales revenue by 5, 10, 15, 20, and so on, the sales revenue because of the sales volume. So I precise where is the information about the sales revenue, the change in percentage is in C7. For the EBITDA, where is the information is here. For the change in operating working capital, where is the information is here. Where is the information about the operating cash flow is here. I say this is where you can find the information. Give me the numbers for different values of the change in sales revenue. So I select all the cells with the data and the empty cells I want to complete. I go to data, what if analysis, and data table. I say we have nothing in the row. On the line, I don't have an input. The input is only in the column, and it's the sales revenue. The cell I will have to change is this one, C7, and I want to change the 10% to 5%, 15%, 20%, and so on, and give me the values. So here, here we have not in percentage but in value, and here the situation, and here we can hide this one. We don't care about this line. And now we have the different situation. So here the situation will increase, so it's not enough. I will change this one. I will put 70%. 70%, and I have positive number. One is positive. And here 40%. And here more 15,000. Yes, now it's okay. Yes. So the situation with a huge variable cost in percentage of sales revenue, 70%. A huge operating working capital in percentage of the, normally the annual sales revenue, okay? And suppose here is annual sales revenue, here variable cost in percentage of sales revenue, and here in percentage of annual sales revenue. Change is annual sales revenue. So in this situation, when I increase the sales revenue, the percentage, I increase the percentage, I decrease the operating cash flow. So in this situation, the change in operating working capital we have here is higher than the change in EBITDA. So if we take the change, Here we have the change. So the change in this one is higher than the EBITDA. So we can represent here with a diagram. Insert. I'm not sure I will find the good one. What is this one? Not exactly. Yes, like this one. Yes, is this one? Or this one? Okay. No. Yeah, this one. So if I have, I will put more cost fixed cost. Here now it's this one. EBITDA is already negative. No, not from the beginning. So I put only 5,000. Okay, it's positive, and the operating is already negative. If I put only 3,000, you mean? Okay. So the problem here, I increase more if you see the slope of the change in operating assets. So here, take this one. If you see the slope of the operating working capital here, I increase more this one than the EBITDA. So because of this, I reduce the operating cash flow. So I started with some operating cash flow around 1,500, and I finish with less than 1,000 at the end. So it's very important the way you manage your operating working capital. So it's why we use the operating working capital in function of the sales revenue. The situation here normally is to decrease the ratio. If you decrease the ratio, you modify the slope, this one, you try to reduce the evolution of the operating working capital in order to reverse the direction and now to increase the operating cash flow. So if you increase your sales revenue by 40%, maybe, you should increase your market share. If you increase your market share, you can better negotiate with the suppliers and the customers. So you can reduce the operating working capital in percentage of the sales revenue. So the operating working capital represent, for instance, at the beginning, 30% of the sales revenue. Because of the increase by 40%, you increase more this one than this one. So you reduce the 30%. So for instance, now it's no more 30%, but only 24%. So in order to have a better performance in terms of how you manage the cash flow, what is important also sometimes is to replace some variable costs by some fixed costs. So I try to reduce the 60% in order to increase the slope of the EBITDA. Here, if you reduce, you increase the slope, and you put more fixed costs in order to have a better situation in terms of operating cash flow. Because the problem with the variable cost, it's you are consuming the cash you are creating. With the fixed cost, you invest one time, but you are not supposed to invest all the time. So you save the cash after the first decision to invest. And if we want, we can calculate also the free cash flow. So the question of the free cash flow, if we add the question of the free cash flow here, we need to include the net capex. So now we have the net capex. Net capex means investments in property, plant and equipment and intangible assets minus divestments in the same assets. Investments minus divestments in these assets. Now you have the free cash flow, but here's the free cash flow before tax, okay, before income tax. In this example, we don't care about the income tax. So if we suppose in your inputs, you need to invest in function of the sales revenue. So for instance, 5% of the sales revenue. Now you will deduct the 5% of, so you need to, yes, 5% of the sales revenue. So now the free cash flow is the sum of the two. So now you take also the decisions, the investing decisions. You can calculate again, but by including also the free cash flow at the end. You can add the free cash flow. So it depends on the business model. Sometimes you need to invest when you increase the sales revenue. So it's a kind of variable cost, but it's not in the P&L. It's a variable cash flow. Sometimes you can say it's just the gross fixed assets. We can keep the same gross fixed assets. It's constant. So it's a very good situation. You don't need to invest in order to develop your sales revenue. Sometimes you say it's a property, plant, equipment at net value, which is constant. So when you depreciate, you need to compensate your depreciation with a net capex equal to the depreciation and amortization expense. So you can have different situation, different business model. So we can have another one with, we suppose we have a gross fixed asset which are constant. Okay. In this case, you don't need to invest at all. And you can have the situation now it's a net fixed asset which is constant. So it means here net capex is equal to the depreciation expense. In this case, you have to define what is non-cash. Here we have non-cash fixed assets. We include some depreciation and amortization expense. For instance, 500. So it means here we have the same in this one. So we need the investments we need. It's 500. So here we can precise which are constant. So we can say here in the calculation in this one, we have to put the depreciation expense, the equivalent of the depreciation and amortization expense. So in this case, we include this one. So we can have different business model. This one you need to invest. So first business model. In this one, you need to invest a lot in order to develop your activity. Second business model, you don't need to invest at all. You have already the capacities and it's enough. And the third business model, you need to keep the same capacities. Because in the situation number 2, you decrease your capacities in reality. You decrease the net value of the fixed assets because of the D&A expense. So you can decrease your capacities. We suppose the D&A expense doesn't represent the real reduction in capacities. Two versions. Okay, so maybe after the course in the evening, I will create the chart again, but with the free cash flow in the 3 business model, and I will put some explanation, okay, about the 3 business model. So I keep this one, and I give you this Excel file later. Okay. Just to say, we can have some liquidity problem in function of the EBITDA and the change in increase in the change in operating working capital. If the change in operating working capital is higher than the EBITDA, because we need a huge operating working capital, 40% of the annual sales revenue is very huge. So because we need 40% and we spend a lot in the variable cost, so we keep only 40% of what we create in terms of revenue, we can finish with a negative operating cash flow if the increase in sales revenue is too high. Yeah, I have a problem. Why I killed the 3000? I don't know. I changed something. Now I don't have the good value. So I will change later and I will show you again the calculation. Maybe I change the cell. I need to do again all this. So I take this. I eliminate all this. Ah, no, it doesn't want. Okay, yes, exactly. I take now, change in sales revenue in percentage. I want now the EBITDA. I want the change in operating working capital. I want the operating cash flow, tax, and I want the free cash flow. I say we take the situation of 5%, 10%, 15%, 20%, 25%, 25%, 30%, 35%, and 40%. Okay. And I create the line with the information. Okay. Maybe we will have a problem. So I will do it later in the other case. EBITDA is here. Change in operating working capital is here. Operating cash flow is here. Free cash flow is here. And now I create again with a data table. In the row, I have the data about the 10%. Okay, I eliminate the chart. I have to create the chart. So it's strange. No, I have again the problem. So I will see the problem later, but if you have the same value all the time, it's not normal. So I will see I have a problem in the links, in the data for the operating cash flow. Operating cash flow, it's C14 increase. Okay. I have to check later why I have this problem. So I keep this Excel file and I show later. So I come back to the PowerPoint. And I forgot, after the break, sorry, I forgot the correction of the statement of cash flow for a young company. So we do the correction after the break of the statement of cash flow for a young company. I asked to you to do it for this session, and we will do after the break, the correction. So the operating working capital, it's a very important amount to manage when we talk about this one about operating efficiency. So when we talk about operating efficiency, we think about the operating working capital and the different items inside the operating working capital. So the net cash and short-term financial assets is the difference between the current financial assets and the current financial liabilities. So you have something positive here if your working capital is higher than the operating working capital, because working capital is equal to the operating working capital plus the net cash. So I put directly net cash for all this. So the net cash is positive if the working capital is higher than the operating working capital. So in the situation of Apple, we can calculate the operating working capital, the working capital, and the net cash. What we name simplified balance sheet, it's with the three items, working capital, operating working capital, and the net cash and short-term financial assets. If everything is positive, we have here the source of financing. So here it's suppose we have an excess of long-term financing over the long-term needs. Thanks to this excess on the long term, we can finance short-term needs. We need to finance in the short term the operating working capital, and we need a positive net cash. So here is the use of financing. Because of the operating activity, because of what we keep in the financial assets. And in fact, is by difference, we have this one. So we can go to the Excel file for Apple. So on Canvas, you have for the session 3, Apple balance sheet for the year 2020, 2019, 2018. You can download the template. And what we want, I put with answers. So what we want is to calculate the working capital. So the closing date for Apple is the last Saturday of September. So we want the working capital at the end of during the last Saturday of September 2020, 2019, 2018. So the working capital is equal to the operating working capital plus the net cash. So we want the three values all the time. What is interesting is to check the evolution. To increase more the working capital than the working capital requirement. If we increase more the working capital than the working capital requirement, it means we increase the net cash. How can we explain the increase in working capital? The increase in working capital is in function of the increase in the long-term financing and the increase in the long-term needs. If we increase more the long-term financing than the long-term needs, we are increasing the working capital. So I let you 10 minutes to complete these tables and we do the correction, okay? So you have the balance sheet on the left side. And from all this information, can you complete the three tables? During this time, I will check where is my mistake. So 10 minutes to calculate all this, and I will check this part. Okay, I finish the stream model, I modify, and I will put the comment after. So we do the correction. So the working capital is very easy to calculate. The working capital is the total current assets minus total current liabilities. So here for April, you can see the working capital is positive. The net cash is the cash plus marketable securities minus the short-term debt. So here you have the term debt. Okay, so C14 plus C15 minus C35. And the working capital requirement is the rest. So you can use the working capital minus the net cash. So the working capital is highly negative. Thanks to the negative working capital requirement and the positive working capital. So they have an excess of long-term financing about what they need because of the accumulated investments in non-current assets. They don't need to use the excess of cash in order to finance the working capital requirement because it's negative. So it's not a working capital requirement in reality. When it's negative, it's a working capital excess, the source of financing. Okay. So they have two sources of financing, from the long term, from the short term. With the two sources of financing, they create a huge net cash. So in this situation, two sources of financing, excess of long-term financing over long-term needs. And they have an excess of short-term financing from stakeholders over the short-term needs because of the operating activity, those inventories, the account receivable. With the two excess of financing, what they finance, the two excesses of financing found the net cash. So we have a huge net cash because what we have to finance at the end is only the cash, because all the inventories, the account receivable, the prepaid expenses are already financed by the stakeholders, thanks to the accounts payable, the tax liabilities, the deferred revenue, and so on. Now the evolution. So if we want the cash flow, the change in net cash, we want the change in working capital and the change in working capital requirement. So here we decrease the working capital. It was not the same situation in the previous year. For the change in working capital is minus, so we do the reverse. This one minus this one, opening minus ending. So here it's good because we increase the negative amount in 2020. So it's positive. But because we decrease more the working capital than we decrease the working capital requirement, in reality, the positive number is it's a decrease because we are more negative now. We decrease the cash. So the evolution of the cash flow is in function of the evolution of the two, evolution of the excess of long-term financing and the excess and the evolution of the excess of short-term financing. how can we explain the decrease in the excess of long-term financing? We can check the evolution of the equity, evolution of the non-current liabilities, and evolution of the non-current assets. With the three, we have the evolution of the working capital. So for the equity, we have the equity here. So we decrease the equity. So this is the problem. If we also increase the non-current assets in the same time. For the long-term liabilities, we increase the long-term liabilities, but we increase less the long-term liabilities and we decrease the equity. And now it's the reverse, opening minus ending for the non-current assets because we want the minus. So opening minus ending. So we increase the non-current assets. And at the end, we explain why we decrease the working capital by 18,780. It's because of the huge decrease in equity, and we need to increase the capacities, but we don't have the financing of the increase in capacities in front of this. So we have a huge decrease in working capital. So now we can see in the equity what is the problem. Why we decrease the equity in this way? So we decrease in a huge proportion the retained earnings. So what is the problem? Maybe we distributed too much dividends. If we distribute more dividends than the profit, we decrease the retained earnings. So the change in long-term financing is equity and non-current liabilities. So we decrease the long-term financing. At the same time, we increase the long-term needs. So of course, we decrease the working capital. But already the same situation in 2018-2019, the evolution from 2018 to 2018. We had a decrease in equity, decrease in non-current liabilities, so a huge decrease in long-term financing, but it was a totally different situation because in this situation, we decrease the non-current assets. So it was normal to decrease the long-term financing because at the same time, we decrease what we need to invest for the long term. So at the end, we had an increase in the net cash because we increase more the working capital than we increase the working capital requirement. It's okay with the comments? You understand the logic? So here the logic is to separate the long term from the short term and to explain the net cash by the evolution of some excess in the long term and some excess or needs for the short term. This is the idea of the simplified balance sheet. You have this kind of presentation in the financial accounting and reporting book. Do you have questions? No? Yes? Do you have other example to practice now? Yes, I will give you example from the book. It's a comparison of the Chinese petroleum with the British petroleum, I think. And they use the working capital requirement and the net cash. So yes, I will scan the book with this example, and I will give you this example for the comparison of companies in the petroleum. So I will put on my document that I have to scan the example. Scan the example Example of the simplified balance sheet. Okay. Simplified balance sheet. Other questions? No? Okay, I continue. So if the operating working capital is negative, it's a source of financing. So on the right side, I have the sources of financing. On the left side, I have what I finance, what the company finance. So because the operating working capital is negative, it's a source of financing. In reality, we have more financing from the stakeholders than what we need because of the operating activity. So here, this is the situation of Apple at the end of Saturday, the last Saturday of September of 2020. We have a huge negative operating working capital. So in reality, we can create a huge net cash thanks to the two sources of financing. Another exercise now. This is the current situation. So the long-term financing is 12 million. What we need to finance is 10 million in the long term. So the working capital is 2 million, the difference between the two. What do we finance with the 2 million? We finance the operating working capital and the net cash. There is a mistake here. Yes, no. Yes, and the 2 is 2 million. Yes, no mistake. So we finance this one and this one, okay? So we have by difference with the minus the calculation from the long term, and we have also the what we finance in the short term. And now the expectation. We don't want to issue shares or to repurchase our own shares during the next year. Because of the investments, we expect to increase by 10% the property, plant, equipment at net value. So here it means because of the difference between net capex and D&A expense, we increase by 10%. Don't forget, it's at net value. So it's the difference between the two, investments minus divestments minus D&A expense. So we increase by 10% this one. We expect to increase this one. Because of the increase of the activity, we expect to increase the operating working capital by 20%. We want to keep the same net cash and short-term financial assets, and we expect a net profit by 400,000. Can you tell me what is the long-term debt, the non-current portion of the long-term debt we need in order to respect all these constraints? So we have the Excel file. Go to Canvas and download the Excel file, small exercise. So small exercise, working capital requirement, and long-term financing. So where is small exercise, version 2. And I will put with answers. So we have the current situation, we have the expectation with the change in percentage, we have the expectation in value, and we have to find what is the long-term debt we need in order to respect the different constraints. So I let you 10 minutes to calculate and we do the correction. During this time, no, I don't put for the moment the Excel file. The other one I need to put the comments. I can put this one, yes. This one is okay. Okay. So we don't want to issue new shares. We don't want to repurchase our own shares. So, and you can precise no issuance of shares and no repurchase of shares. So no equity financing. And no dividends. We can precise we don't distribute dividends. And also no dividends. So we keep all the net profit. In the financing cash flows, we don't have equity financing. We have only debt financing. Do you have the answer? No. 840,000. We check. So increase the property, plant, equipment, and intangible at net value because of the net capex minus D&A expense. So now it's 10 million multiplied by 1 plus the 10%. We increase the operating working capital because of the increase in the activity. Increase the sales revenue, you can suppose. So now the net cash, the operating working capital is 1,440,000. We want to keep the same net cash, so no change. So now we can calculate the working capital we need to finance. What we need to finance with the excess of long-term financing is the operating working capital plus the net cash. So we need to finance this. And we also need to finance the long-term investments, accumulated long-term investments. So what we need to finance is the excess of long-term financing plus the property, plant, equipment, and intangible assets at net value. So we need in the long-term financing 13,240,000. And in this one, have already the opening long-term financing. We suppose we keep the same. And we have already the impact of the net profit of the year. So what we need to finance is the rest. So here, we suppose we continue with the same long-term financing. We need to add a new amount, but don't forget, thanks to the net profit, we increase the long-term financing. So the debt you need is 840,000. So yes, you have the good answer, 840,000. Okay. So annuity is a kind of net new long-term debt. So net new long-term debt, because it's a long-term financing. Net means here new debt minus repayment of the debt. So it's a net new long-term debt. So we need to have more new financing than the repayment of the debt by 840,000. So yes, you have the good answer. So I hope with this example you understand the logic. You have to finance something for the short term, you have to finance something for the long term. Do you have enough long-term financing for this? For the long-term financing, don't forget, you have the impact of the net profit, the impact of the issuance of shares, the repurchase of shares and the dividends, and the rest is because of the debt. So the logic is here. The working capital is the difference between the long-term financing and the long-term needs. And with this excess, you finance what you need in the short term because of the operating activity and the net cash. So we increase the non-current assets by 10%, we increase by 20% the operating working capital. We have no change in the net cash. What is the increase we need in the equity and non-current liabilities? After we have this increase, we deduct the net profit, because thanks to the net profit, we increase the long-term financing. So now we have the rest of the financing. There is a mistake here because we said it's 840,000. So 840,000. So we need to increase the long-term financing by 10.3%, but with the net profit is not enough, so we need new debt. Net new debt. Different with the repayment. So one question: having a positive working capital and a negative operating working capital would most likely result in a positive net short-term debt or a negative net cash and short-term financial assets. So when we have a negative net cash, we say also we have a net short-term debt. It's equivalent. So it's true or false? False, exactly, it's false. It's false, it's totally the reverse. It's the best situation in terms of net cash. We have two sources of financing. Because the working capital is positive, it's a source of financing from the long term. Because the operating working capital is negative, is also a source of financing. So at the end, what you can finance, the rest is only the net cash. So you are sure you have a positive net cash and short-term financial assets. Last question, and after the break, or we do the break now, and we do this question just after. So I don't use Kahoot today because we use a lot of Excel file. I don't have a lot of MCQ, so we do directly here. We'll use Kahoot more maybe the next time or during the last session. So we do the break now, and we continue with this part just after the break, okay? See you in 10 minutes. And I will scan the book for tomorrow. I don't have the book here, it's at home. So I will come back to my school tomorrow and I scan the book for the part about the working capital, the operating working capital, and the net cash. So I stop the recording and we start again in 10 minutes. We continue the session. So what is interesting with this presentation, just I come back to the presentation here. When we look at the statement of cash flows, we have the impression that the net cash is defined at the end. The change in net cash is in function of the operating cash flow, the investing cash flow, and the financing cash flow. So the change in cash is the bottom line of the statement of cash flows. But in reality, when you take the business decisions, you already know what you want for the change in cash. Here, we want to keep the same cash. So we want a change in cash equal to 0. In function of that, we need to compensate with the financing activity if with the operating activity, we can finance what we need for the investing activities. So in reality, the change in cash is not in function of the rest of the decisions, is already here from the beginning when you forecast your activity for the next year. You know you don't want to finish with a negative cash account with a bank overdraft. So if you need more financing, you will have a new debt or you will issue some shares, but you will find a solution in order not to finish with a negative cash account or a very low cash account. So in reality, the cash is not the effect of all your decisions, but is already here from the beginning because you have a target for the cash flow. And if you can respect it, you try to have new debt, you try to postpone some investments, you try to issue shares and so on. You don't distribute dividends and so on. So the problem with the statement of cash flow, we have the impression that the change in cash is in function of the rest, but it's not the case. So the order we have in the statement of cash flows is not the good order, as we said from the beginning. And here in this kind of presentation is more like we want to think about the future. We want to think about what is the cash we want to keep in the cash account in order to pay what we have to pay because of the change in operating working capital because of the increase of the sales revenue, what we can expect in terms of profit because of the activity, and so on. So another question is about what is the operating working capital or working capital requirement in this situation. So I do this one, and after I go to the correction of the statement of cash flow for a young company. Okay, so we do just this one, and I do the correction of what you did for today normally. So here, what is the operating working capital or working capital requirement in this situation? You don't see the slide? I show it again. Do you see it now? Because I see I share the screen. No, sir. Oh, okay. I do it again. Okay, sorry. Why is not working? Yes, now it's working. Okay, sorry. Now you see it normally. It's okay now? You see the slide? Yes, now okay. Sorry. So what is the operating working capital or working capital requirement in this situation? So tell me if you have the answer. 820,000. Yes, I think it's this one. So you don't care about the cost of sales. It's inside the P&L. You don't care about the SG&A expense. It's inside the P&L. So it's operating expenses by function. You don't care about the components used for production. It's operating expense by nature. You don't care about the D&A expense. Is operating expense by nature. So you want the rest. So in the operating assets or current operating assets, you have 820,000. You add all the inventories, the accounts receivable, and the prepaid expenses. In the operating liabilities, you have the accounts payable and the accrued expenses. Accrued expenses means is already expenses, but is not already paid. So we have the impact on the P&L because it's already expenses, but not already paid. So we don't have the impact on the cash. We do the difference. So what the company needs to finance in the short term because of the operating activity is only 420,000. The rest. So inside the 820,000, 400,000 are already financed by the stakeholders. Only the rest must be financed by the company. So is what you said, 420,000? No, too much. 420,000. Okay? You forgot the operating liabilities. So now what I propose to do is the correction for the Young company, the statement of cash flow. So I hope you try to do this exercise for today, because we go directly to the correction. So here, the company starts the activity in February 2021, and they want the forecast of the cash flows for the period. We propose to create the statement of cash flows with the indirect methods and with the direct methods. Indirect or direct methods, you have the choice only for the operating cash flow. For the investing cash flows and the financing cash flow, of course, you can use only the direct methods. You show directly the receipts and the disbursement. So now we start with the P&L. We start from the P&L because we want the indirect methods. So don't forget, in your P&L, what you want is the expense in function of what you sell. You match expenses against sales. So the sales revenue expected for 2021, it's 1.2 million. So we expect 1.2. Now the components used for production, it's equal to what you purchase plus the opening components inventory, but we don't have opening components inventory. We don't have the information here. So we suppose we don't have opening components inventory, but we know that at the end, we expect the equivalent of 5% of the sales revenue in the components inventory. So here is expressed in function of the sales revenue. So how do you find the 5%? For instance, so here we say is the value of the components inventory divided by the sales revenue. So here we have the components inventory in value divided by the sales revenue. So here we can decompose this ratio. It's in function of the cost of the components, cost of components per good divided by the sale price, the selling price per good for one good, what you produce, okay? It's a proportion of this because in the components inventory, you have the unit component cost multiplied by the volume. In the sales revenue, you have the selling price multiplied by the sales volume. Okay. So it's in function of the cost of the components per product in percentage of the selling price. So here we transform unit cost, and it will be in function of the volume you want to keep in your inventory in proportion of what you sell. Multiply by the proportion of components in function of sales volume. So if you want to estimate for the future, to forecast the inventory in percentage of the sales revenue, in reality, you need to know what you spend for the components in function of the same price, and you need also the proportion of components you want in function of what you expect to sell. If you have the two, you can estimate the components inventory in percentage of the sales revenue. So, and why we want in percentage? We want in percentage because we can create, I forgot to create it. After we can use everything in percentage. Generally, we say, what is the common size? What is the common size statement of cash flows? In the common size statement of cash flows, common size statement of cash flows, we express everything in percentage of the sales revenue. In percentage of sales revenue. So it's because also if we want to analyze the statement of cash flows with the common size statement of cash flows, we express in function of the sales revenue. Format here. Okay, so here's the common size statement of cash flow. And what we can do also, for instance, for the calculation of the operating cash flow, the different methods we can use for the operating cash flow, like a common size income statement, is to say we want the sales revenue, we want the variable cost in percentage of sales revenue, we want the fixed cost in percentage of sales revenue, cash fixed cost, cash variable cost, what we have to pay. So now we have the EBITDA in percentage of sales revenue. After we have the increase in components inventory in percentage of sales revenue, increase in finished goods inventories in percentage of sales revenue, increase in account in percentage of sales revenue, increase, but it is negative, no, it's positive here. Increase in accounts payable in percentage of sales revenue. So here we can precise is negative between parentheses. Okay, with all of this, we have the operating cash flow in percentage of sales revenue. You multiply this by the expected sales revenue, and now you have the operating cash flow. Okay. So it's a different presentation, which is interesting because you know also by donks of sales revenue what you keep in terms of operating cash flow. So it's interesting for the operating cash flow and also for the free cash flow. Okay. So we will complete also this one after. So I continue. So don't forget, if we have the components used for production, here it means it's this one is in function of the production volume. But in your P&L, what you want is not in function of the production volume. What you want is in function of the sales volume. The operating profit is in function of the sales volume. So is why you use the increase or decrease in finished inventory in order to keep only the expenses in function of what you sell. If you produce more than what you sell, you have too much expenses. You have to eliminate some expenses. If you produce less than what you sell, you don't have enough expenses during the period. So you have to take the expenses of the period plus what you take from the opening inventory. So when we have an increase, it's like a kind of revenue, but it's not a revenue at all. When we have a decrease, it's a new expense. So the increase in rate, it's a reduction of the expenses. We put too much expenses before, so we need to eliminate some expenses. So it's, here I need to put in negative. So I put the expenses in negative in order to consider the increase as a positive amount. We have the employee cost. The employee cost is here. We have the purchases not for inventory is here. We have the D&A expense, So the D&A expense, it's the investments divided by 5 years. So now we have the annual depreciation expense. But don't forget, we start to depreciate when we use the property, plant, equipment. We start to use the property, plant, equipment at the beginning of February. So multiply by 11 divided by 12. So we don't use it in January. So we use it only during 11 months. So 15,000. During the period, we increase the finished good inventory because we don't have at the beginning opening finished good inventory. So the assumption here from the data available, no opening inventories at the beginning of February. Okay. We have no information, so we suppose we don't have opening inventories. So if we don't have opening inventories, the increase is directly the ending inventory. So the equivalent of 10% of the sales revenue. So we finish with 120,000 in the ending inventory. If we want, we can calculate directly all the ending components of the working capital requirement. So we can take the 5%, multiply by the sales revenue. We put dollars for the sales revenue, and we do the same for everything. We finish with the 120,000. Okay. And here the components used. Up, we eliminate because of the ending components inventory. So now we have the operating profit, or EBIT. It's the sum of everything. So we have 175,000. Now we need the interest expense. We finance 50% of the investments with the debt. So the debt is equal to 150,000. The annual interest rate is 4%, but we start the financing, the debt, at the beginning of February. So multiply by 11 divided by 12. So don't forget the interest expense is for the period you use the debt. You use the debt only during 11 months, not the 12 months of the year, because we start the activity at the beginning of February. So 5,500. So the profit before tax, the sum of the two, so it's 169,500. Now, in the indirect method, we can start from the profit before tax or the operating profit. So here I start with the operating profit. In the other presentation, I start with the profit before tax. We don't have income tax here, profit before tax. So here, potential cash flow from profit before tax. Potential cash flow from profit before tax. Okay, and we don't have tax assets or tax liabilities. So the starting point can be the EBITDA, the EBIT, the profit before tax, the net profit, if we have income tax. So if we start from the operating profit, we need to eliminate the non-cash expense. The non-cash expense, it's the D&A expense, 55,000. We don't have non-cash revenue, so the potential operating cash flow, it's all of this, it's 230,000. What do you do with the potential operating cash flow? You have to pay the interest. What you pay for the moment is nothing, because we say the interest paid annually at the anniversary date. So you have a very good negotiation with the bank. You negotiate it to pay only one time per year the interest. and you pay nothing for the moment. So we don't have interest paid. So with all the interest expense, what you are creating here with the interest expense, it's accrued interest payable. In your balance sheet at the end of the year 2021, you will have the 5,500 in the liabilities in the accrued interest payable because nothing is paid for the moment. So we have exactly the same potential operating cash flow after interest paid. Now the potential operating cash flow after interest paid is this one. Now we need the increase or decrease in current operating assets, increase or decrease in current operating liabilities. So what we need is the change in working capital requirement or operating working capital. So in the components, we increase the components by 60,000 because we start from 0. We increase the finished inventory by 120,000. Increase the accounts receivable by 180,000. So the increase in current operating assets is the sum of the three. If we want to show directly this one, we can put the total of the three. So the sum of all of this. Okay. In the current operating liabilities, we have only accounts payable. We increase, so it means we don't pay for the moment. We save the cash, so it's plus or equal 120,000. We have only this in this one, so we put only this one. So now the operating cash flow is your potential operating cash flow after interest paid, plus the increase in operating working capital, operating assets. So it's a negative amount because you increase it, you pay for that, and plus 120,000, you save some cash because you increase your liabilities. So minus 10,000 in the operating cash flow. If we do the same calculation from the profit before tax, now you included the interest expense. So don't forget, you have to eliminate interest expense because we don't pay the interest expense. So we have to include now the increase or decrease in accrued interest payable. So we do the same than before. We eliminate the D&A expense. We eliminate the non-cash revenue, but we have nothing. Now we do the sum of all of this. We have a potential cash flow from profit before tax. Now from this one, we need the change in components inventory, finished inventory, and so on. So it takes the same. It takes the same for the accounts payable. But now I need also the increase or decrease in accrued interest payable. So because I start from the profit before tax, I need to eliminate the interest not paid. What is not paid is all the interest. So I increase the liability. When you increase the liabilities, it's plus. So we do the reverse. It was minus in the P&L. So now it's plus because we increase the accrued interest payable. We start from 0, and now we create 5,500. Now we can add everything from the potential cash flow from profit before tax to the accrued interest payable. And again, we have the 10,000. With the direct methods, we put the collection from customers. So we take the sales revenue minus the increase in accounts receivable. So the increase in accounts receivable is here because we don't have opening accounts receivable. So minus the ending accounts receivable. So we have 1,020,000. In the employee cost paid, we have 400,000. In the payment to suppliers of components, we can start from what we purchase. We purchase 600, but we increase the accounts payable. We suppose the accounts payable here are related to the suppliers of components. So here minus the ending accounts payable because I don't have opening accounts payable. So directly minus the ending. So here I need to precise, I suppose, ending accounts payable from suppliers of components. Okay. Now the payment of suppliers of water, electricity, and the rest. So what I purchase is here, the 150,000. Now I can add all these cash outflows, and I can do cash inflow minus cash outflow. So minus 10 again. Okay, so all the time I have a decrease by 10,000 of the opening cash because of the operating cash flow. So if I have only operating cash flow during the period, I will decrease the cash by 10,000. The cash account by 10,000. So now we can continue with the investing cash flow. So we have the investment in property, plant, equipment. So it's a negative amount. The cash outflow, we invest 300,000. We don't sell some property, plant, equipment, or intangible assets. So the net capex is the sum of the two, minus 300,000. So if we want the free cash flow, we take the minus 10, minus 300,000. So the free cash flow is minus 310. We don't purchase some financial assets. We don't sell some financial assets. So here we have only the net capex in the investing cash flow. In the financing activity, I separate the equity financing from the debt financing or financial liabilities financing. Issuance of shares here. What is the financing activity? We don't have information about the financing activity for the issuance of shares. So here is just the debt. So I forgot. So I will complete. Sorry, I will put some issuance of shares because in this case I will have a big problem. Or we separated the initial activity. So we will do without the issuance of shares, but of course, if we start the activity, we need some issuance of shares. So I have a new debt. The new debt is 50% of 300,000. So here in the financing cash flow, I have only the new debt, 150. Now I can calculate, I can calculate the cash flow of the period. The cash flow of the period is the operating cash flow, plus the investing cash flow, plus the financing cash flow, minus 160,000. If I put the issuance of shares, so now I can say what I need to issue at the minimum. I need to compensate the minus 160,000. So we can say in the, we can add here, for instance, after we'll add some lines. We can add the equity financing. And we can say we have issuance of shares because we start the activity at the beginning of February 2021, and we expect to issue 180,000. Wow. Percentage. Take the same kind of same. 180,000 or 200. I want in the same color. Okay. So now I can add in the financing activity the issuance of shares, 100,000. So at the end of the period, I increase the cash flow by 40,000. So if we want, we can create some balance sheet. At the beginning, we have only external financing and investments. So at the beginning, we have the 200,000. We have the 150,000 with the debt. So we have 350,000 from external financing, and we have the investment of 300,000. So the opening cash is 50,000. Opening cash is 50,000. Thanks to all the financing, we increase the cash to 40,000. So it means we started with 50,000. So we decrease the cash by 10,000 because here we have 40,000 at the end of the period. So we included everything in the 40,000. So it means we start from 0 and we finish with 40,000. So if we create the balance sheet at the beginning of February, and at the end of 2021, format. Okay. So we can put the current assets. In the current assets, we can put the cash and cash equivalents. We have the components inventories. We have the finished goods inventory. We have the account receivable. So now we have the total current assets. After we have the non-current assets. The non-current assets, we have property, plant and equipment at net value, or we can start at gross value. Minus accumulated depreciation. Now we have the property, plant and equipment at net value. So now we have the total non-current assets. So now we have the total assets. On the other part, we have the current liabilities. The current liabilities, we have only accounts payable and accrued interest payable. So now we have the total current liabilities. In the non-current liabilities, I forgot something. I forgot the current portion of long-term debt. In the non-current liabilities, I have the non-current portion of long-term debt. That's it. So now we have the total non-current liabilities. After I have the equity. In the equity, I have the capital stock and additional paying capital, or what we name also share capital and share premium. So from external financing, I have the retained earnings. And as you do in Vietnam, you separate retained earnings from profit of the year, from the retained earnings from previous profits. Okay. Now we have the total equity. And now we have the total liabilities and equity. Okay. At the beginning, the cash you will have by difference. It's a plug. So you invest, the company invests in property, plant, equipment. So they invest 300,000. We don't have for the moment depreciation. We start the activity. We don't have current assets. Not yet. We have current assets. We will calculate the cash after. So the total non-current assets is just this one. Total assets, it's this one plus this one. We don't have current, yes, we have current liabilities, sorry. We have the current portion of long-term debt. You borrow 50% of 300,000, and you will pay over 5 years. We suppose we have constant linear repayment, so we divide by 5. So it's not in years. Change the format. So I said 50% of the investment is financed by debt, and you will pay 1/5 per year. The rest of the debt is in the long-term debt. So it means it's 50% of the investments minus the current portion. The current portion, 30,000. So in the current liabilities, I have only this one. The non-current liabilities, I have only this one. I change the format. I have only this one. In the capital stock, I have the issuance of shares. So here is equal to the issuance of shares, 200,000. In the retained earnings from the profit of the year, nothing here. So here in the total equity, I have directly only the capital stock and additional paying capital. So 200,000. In the equity plus liabilities, I have 350,000. And now I can calculate the cash. The cash is equal to the 350,000 minus what is included in the non-current assets, minus the rest, the components inventory, minus the finished inventory, minus the account receivable. So it's a plug, it's by difference. We'll come back on this during the session 5. It's another way to create a kind of statement of cash flows. You calculate your net profit, you put the net profit in the balance sheet, you calculate the forecast for all the balance sheet, and the last line you have to complete is the cash. So you have 50,000 in the cash at the beginning of the year, in February. I changed the format of this one. Okay, and now at the end of the year, the components inventory is equal to 60,000. The ending finished inventory is just below, so I can use the same here. So the current assets is the sum of all of this. The cash, I can have the cash by difference. For the property, plant, equipment, I continue with the same value. So, sorry. I continue with the same value. But now I have the effect of the depreciation. So I reduce the value because of the depreciation. So now at net value, it's 245. The total current asset, non-current assets, it's only this one. The total assets is all of this. In the accounts payable, I have now here the 120,000. In the accrued interest payable, I have the interest not paid, so all the interest expense. In the current portion, I continue to expect to pay 30,000. I add all this. I continue with the same non-current portion because for the moment I pay nothing. So now I have all these values. I don't issue new shares during the year. Now I can put the profit of the year inside the retained earnings. So here it's just profit before tax. So the retained earnings, it's this one plus the impact of previous years, but we don't have previous years. So the total equity is the sum of the capital stock and retained earnings. So the total liabilities and equity, it's 645. I finish with 40,000 in the cash. So you see, you have exactly the same result with the two calculations, this one or this one. Okay. So you can create a kind of statement of cash flow with a balance sheet and P&L. We have the P&L forecast and we have the balance sheet forecast, and with the cash and cash equivalent as the plug in your balance sheet. It means it's by difference you have this one. I have already something green. Yes and no. Nothing is green. Okay. So two methods to calculate the same thing. And here the change is only minus 10,000 because in the change I have here, I have only the operating activity. So the change here is coming from operating activity, because all the investing activity and financing activity is already here at the beginning of February. So investing and financing activities are in the balance sheet at the beginning of February. At the end of the year, now I have also the operating activity. So of course, here, if I do this one minus this one, I will put in yellow or in blue. Oh no, blue, I have already the blue. In orange. So what I have in orange is equivalent to the minus 10,000 here. Okay. Because during the period, I have only the impact of the operating activity. All the financing activity and investing activity is already here at the beginning. And do also everything with a change, and you will find again all you have on the calculation with the indirect methods for the operating cash flow. If you do that, you will see all the difference you have from the so you start from the profit. From the profit, you have to eliminate the impact of the D&A expense. So the D&A expense is here. So you have the impact here. You take into account the increase in component inventory, increase in finished inventory, increase in accounts receivable. We have also the change in accrued interest payable and accounts payable. And that's it. So all this information is used in the operating cash flow with indirect methods. Because here the change is only because of the operating activity. So it's equivalent what we have here and what we have in this part. No, from the profit before tax in this one. So you have the same values than here. Okay. The 169,500, the 55, the 60, 120, 180. Okay. And here we have, so we have the change in assets equal to the change in liabilities plus the change in equity. In the change in assets, we have the change in cash and the change in non-cash assets. So if we want the change in cash, we need the change in liabilities plus the change in equity minus the change in non-cash assets. We put on the other side. The change in the equity here for the operating cash flow is the net profit. The change in non-current, non-cash assets is the D&A expense. But it's a minus because it's a reduction, okay? Reduction in the value, so it's plus. So minus, but we have the minus before. And we have all the change in current operating assets. In the change in the liability, we have all the change in the current operating liabilities. And again, you have the classical calculation, net profit. Step number 1, I eliminate the D&A expense. Step number 2, I want minus, I have the minus before the non-cash assets, minus increase in current operating assets, plus increase in current operating liabilities is equal to the operating cash flow. So you see, you can have the same with the change in your balance sheet. So I save this Excel file and I put the Excel file. I forgot something. I forgot to do in percentage. We say we will do in percentage. So here the problem is, what do you consider as variable? Variable, we will suppose, for instance, is components. Purchases, not for inventory, is not clear. One part can be variable, one part can be fixed. Or we don't use the variable cost. So we will use a different presentation maybe. We'll suppose here we put before, and we will put the components spent in percentage of sales revenue, the employee cost in percentage of sales revenue, and the purchases not for inventory in percentage of sales revenue. So the sales revenue in percentage of sales revenue. So we start with 100%. So we start with this one divided by this one. After we have the components expense, so I could use different lines. I will use this one divided by this one. Component expense in percentage of sales revenue is not easy, this one. I put in minus because I have the increase in finished inventory. So it's not exactly this one. I have to take this one, and I don't know the part of the components in the finished inventory. So I have to decide, I suppose. I need new information. Components in percentage, component cost in percentage of the manufacturing cost. So I suppose the here. I suppose the components represent 40% of the manufacturing cost. So if I suppose this, I can eliminate. I have the same problem with the employee cost and so on. It will be very complicated. Or in the other case, I keep the change inventory. Right. Now I will spend too much time because I need to transform everything in order to have only the expense for what I sell. The problem of my P&L, it's I don't have in function of what I sell. In the employee cost, I can have employees in the factory. I can have employees in the commercial, administrative, and research and development part. So I need to split and to take the employee cost in the factory only in proportion of the sales revenue. I need to do the same for everything. So because here I directly have all the cost for the period. But for the period, sometimes it's in function of the production volume. For the period, sometimes it's in function of the sales volume. So it's a problem if I want directly in function of the sales revenue. So I will transform this exercise and I will put more information in order to be able to do this one. But here I can do it, or in the other case, I need to show this line, this one in percentage, okay, which is not very relevant. So I stop here and I will finish the exercise later, but I need more assumptions, more informations. Okay. So I come back to the PowerPoint. So now we can start the managerial balance sheet, the ROCE, and the free cash flow. We'll see we have relation between ROCE and free cash flow. We have the calculation of the free cash flow for the NPV. We will see how we calculate the free cash flow for the NPV, the net present value. Normally the NPV, it's the free cash flow for one project in the future from t equals 0 to the end of the project, divided by 1 plus the discount rate. And normally we use the weighted average cost of capital over T. So we start from 0 because the first free cash flow is your initial investments. And we will see another way to find this one is with what we name the market value added. The market value added is the sum of the economic profits divided by 1 plus the weighted average cost of capital over T, but from T equal 1 to the end of the project. And it's equivalent. NPV for one project is equal to the market value added. In the bank, we know a lot the economic profit. In the bank, we calculate the economic profit with the return equity minus the cost of equity multiplied by equity. We'll see a different calculation for a manufacturing company. For a manufacturing company, we use the ROCE minus the weighted average cost of capital multiplied by the capital employed. But at the end, we finish with the same result. I can show you one Excel file next time in order to show you that the result is the same at the end. So with the managerial balance sheet, we can calculate the ROCE, and the managerial balance sheet is related to the free cash flow also. So the traditional balance sheet, what we see in the financial report, it with the distinction between the short term and the long term. On the other side is the same. We separate the short term and the long term. We have in reality 5 categories: current assets, non-current assets, current liabilities, non-current liabilities, and equity. In the managerial balance sheet, the problem is not the short term and the long term. In one side, we want the capital employed, and in the other side, we want the invested capital. The capital employed is what you use because of your operating activity, is what we name net operating assets. And from the net operating assets, you create the free cash flow to firm. So when I talk about the free cash flow, it's the same as the free cash flow to firm. In your capital employed, you have also the financial assets. On the other side, how do you finance the net operating assets? It means operating assets minus operating liabilities in the short term and the long term. And how do you finance the financial assets? Is with the equity and the financial liabilities. So we keep a balance sheet balanced, but now it's different. All the operating liabilities are on the other side in minus. So we have now on the left side, in the net operating assets, we have the working capital requirement or operating working capital, plus the non-current operating assets, property, plant, equipment, and intangible assets. So maybe I can create in the whiteboard one example. So in the normal balance sheet, we have the current assets. In the current assets, we have current operating assets and current financial assets. We have non-current assets. In the non-current assets, we have non-current operating assets. So mainly property, plant and equipment, and intangible assets. In the Vietnamese GAAP, you put also accounts receivable for more than 1 year, many things that are for more than 1 year. But under IFRS, if it's accounts receivable, it's in the current assets. So it's different, the presentation under Vietnamese GAAP and IFRS, because you separate in Vietnam current and non-current because of the 1 year. Under IFRS or US GAAP is not because of the 1 year only. If the operating cycle is for more than 1 year, we keep in the current part what is related to the duration of the operating cycle. So the accounts receivable normally are in the current assets. And I have also the non-current financial assets. So for instance, investments in associates. So here you own between 20 and 50% of the company. After all these assets, you have the equity and liabilities, or liabilities and equity. So you have the current liabilities. In the current liabilities, you have the current operating liabilities, the current financial liabilities. You have non-current liabilities. So generally is mainly provisions and non-current financial liabilities. The provisions under Vietnamese GAAP or IFRS are discounted. So don't forget here, they are discounted. Because they are discounted, we consider is like a financial liability. And after we have the equity. Okay, so this is the classical balance sheet, and now we create the managerial balance sheet. In the managerial balance sheet, we want in one side the capital employed, and in the other side, the invested capital. So what you don't put in the capital employed is included in the invested capital by difference, okay? So if you decide it's a part of the capital employed, it's not visible in your invested capital. If you say it's not a part of the capital employed, it's in your invested capital, because we want to keep the balance sheet balanced. So in your capital employed, we keep all the assets. So now we can separate the net operating assets. In the net operating assets, we have the current operating assets, the non-current operating assets, and is net because it's minus current operating liabilities. And we don't put the provisions because the provisions are like financial liabilities because they are discounted. So now we have the net operating assets. And the other part of the capital employed, it's the financial assets. In the financial assets, we have the current financial assets and the non-current financial assets. So sometimes the non-current financial assets are considered as a part of the net operating assets. In this case, when you calculate the return on net operating assets, you need to include the share of profit from investments in associates. So here from this, after what you calculate generally, it's the return on net operating assets and the return on financial assets. So on the other part of the balance sheet, in the invested capital, you have the rest. So you keep the equity, and you keep the financial liabilities, including provisions, long-term provisions, financial liabilities, plus non-current provisions. Because the short-term provisions are not discounted. So the short-term provisions can be inside the current operating liabilities in minus. So this is a traditional presentation of the managerial balance sheet. You can have also another presentation. You keep only the net operating assets in one side. So it means you don't keep the financial assets in this part. If you don't keep the financial assets here, you put in minus on the other side. So the other presentation, in this case, its net operating assets equal equity plus the net debt. In the net debt, you have the financial liabilities plus provisions, non-current provisions, minus the financial assets. And generally, what you put is minus the short-term financial assets. So in reality, you keep here plus the long-term financial assets. In this presentation, why we use this one is because we calculate the free cash flow from here. With the free cash flow from firm, we have the market value of the net operating assets. And we can define the market value of equity with what we name the discounted cash flow methods. By saying is equal to the free cash flow to firm, so what we have from the left, minus the net debt, and plus some long-term financial assets if you consider it's not a part of the free cash flow to firm. Okay, so it's a way to calculate the market value of equity from the discounted cash flow methods, is to say we have the free cash flow to firm, it's the market value of net operating assets. For the net debt, we consider we don't have a big difference between the accounting value and the market value, so we keep the net debt, and by difference, we have the market value of equity. So in this case, we use more this kind of presentation. So we want to transform the balance sheet in the financial report into the managerial balance sheet. We can have a managerial balance sheet with a net debt on the right, or as we said, I put the net debt on the right, okay, because I prefer normally to keep the financial assets on the left. So sorry, I will transform, and I will consider a different presentation. I keep the gross debt here. So it's short-term debt and long-term debt, and I will keep the financial assets on the other side. I put the financial assets here in this one. Okay. So we use the other presentation, and we do the calculation. So maybe I will finish this for the next time. And what I propose maybe is format shape. Okay. I put in white. Okay. So if we have this presentation, capital employed, we keep all the financial assets. Invested capital, we have the short-term debt, long-term debt, plus non-current provisions, which is a traditional presentation. So we try to apply to one exercise. So we want the capital employed in one side and the invested capital on the other side. So we have this situation. The non-current assets are 100. The current assets are 80, including cash and cash equivalent for 50. On the other side, in the equity, we have 50. In the non-current liabilities, we have long-term financial liabilities, long-term provisions. In the current liabilities, we have short-term financial liabilities, short-term provision, and the rest. So including, so it's not only this part we have inside the balance sheet. So I precise this, but we have other things also. So can you calculate what is the capital employed and what is invested capital? So in function of this information, what is the capital employed? What is invested capital? Yes. The MCQ, why we don't add back depreciation amortization? Sorry, I forgot to answer to this question. No, it's in the MCQ, it's a calculation of the working capital requirement. We don't care about the DNA in the working capital requirement. You have a question? No? It's other thing, okay. So here, it's not possible to put in Excel, I think. Difficult. I didn't separate the line. No, it's not working at all. Yes, it works. We will resolve the situation in Excel. Okay. So here, what we want now, it's the capital employed on one side and the invested capital on the other side. So what we need is the net operating assets and the financial assets. And now we have the total capital employed. No, it's not this. Increases. In the net operating assets, we have two parts. we have the working capital requirement, and we have the net non-current operating assets. Okay. We keep all the equity on the other side, and after we put the financial assets. In the financial assets, we have the current financial assets and the non-current financial assets. Okay. In the other side, we have the owner's equity. And we have the financial liabilities, including the non-current provisions. No. We have the gross debt of financial liabilities plus non-current provisions. So we have the current financial liabilities, the non-current financial liabilities, and we have the non-current provisions. We don't have all this. Okay. So in the working capital requirements, what we have is the current operating assets. Current operating assets, it's all the current assets minus the current financial liabilities. Financial assets, sorry. So 80 minus 20, the rest. Minus the current operating liabilities, it means the 30 minus the current financial liabilities. So here we have 35. Okay. In the net non-current operating assets, we suppose we don't have financial assets here. We take the 100 minus the rest of the non-current operating liabilities, non-current liabilities. We don't take in the 100 the 70 because it's financial liabilities, and we don't take the long-term provisions because it's discounted. But in fact, we have nothing else. So we keep here only with the 100. So the net operating assets is the sum of the two, 135. In the financial assets, I have current financial assets, the 20, and I have nothing in the non-current financial assets. So the total financial assets is the sum of the two. We have 20. So in the capital employed, we have 135 plus 20, 155. In the equity, we keep all the equity. 50. What is possible to do is to eliminate minus net assets held for sale. So if you have some assets you will sell, you can eliminate from the equity. But here we don't have this information. In the current financial liabilities, we have the 5. In the non-current financial liabilities, we have the 70. We have the long-term provision 30. So we add the 3, all the financial liabilities, and the non-current provisions, 105. We add the equity plus the gross debt plus non-current provisions, or including gross debt, including non-current provision. And now we have again 155. So we continue with the managerial balance sheet tomorrow. And from the managerial balance sheet, we see the link with the free cash flow, with the economic profit. And tomorrow, we will calculate the NPV. We will see we have different calculation of the economic profit. And at the end, when we discount the economic profit, we finish with the same thing than when we discount the free cash flows. Okay? So tomorrow it's about long-term cash flows, the cash flows for the project, the cash flow for the cash flow for project, yes. So from balance sheet to managerial balance sheet. So I will put the Excel file with the correction also on Canvas. So this is a general presentation, but we can have different calculation. It depends if you put all the provisions, you put all the provisions on the right, you put only short-term provisions on the left. So you can have different kind of calculation. So you can have calculation here with only the long-term provision on the right and the short-term provision on the left. Why I don't finish with the same value? I say 155. Where is the 155? 35. 155. It's because the financial assets are on the left. Yes. So I presented in the PowerPoint with the financial assets on the right with the net debt. So I will change the slide, the correction, and I will consider the financial assets on the left. So in reality, what I have here is not the capital employed, but the net operating assets. And here's the financing of the net operating assets. So I finance the net operating assets with equity and net debt. So I change the correction and I put the good correction for tomorrow with the financial assets on the left. And I put the Excel file on Canvas. Okay, so I see you tomorrow. We continue with the manager balance sheet. We see the NPV calculation. We compare with the economic profit, and we reconciliate what we have from the economic profit from what we have from the free cash flow, and we will see the two different approach will give you the same result at the end. So it's equivalent to say we discount the free cash flow to firm, or we discount the economic profits. Thank you to everybody and see you tomorrow. And we continue with the NPV and the discounted economic profits, what we name market value added. With the market value added, normally you explain why the market value of equity is different from the accounting value of equity. Bye. I stop the recording.